Tightening credit spreads have been increasingly on the radar for some market watchers, but should investors be concerned about the risks there? Joining us now to discuss is Rashna Bhatt, VP and Director for Active Fixed Income Portfolio Management with TD Asset Management. Great to have you back in the program, Rashna.
Great to be here, Greg.
So let's talk credit spreads, what we're seeing out there. We're all seeing the headlines where some people are concerned about these spreads being tight and perhaps even remarkably tight considering how much risk we're facing. How should we be thinking about the situation?
Yeah, you know, Greg, a lot has come through this year. We've had plenty of headlines, so let's count them. Tariffs, geopolitical tensions, you've had the French political risk, the macro wobbles that we saw, credit risk events, government shutdown, and just for bonds specifically, we've had a ton of supply come through September. Now, when you put that into perspective and look at where credit spreads are, which is the extra compensation you make when you invest in a corporate credit over government bond, that spread is incredibly low, which means you're at the tightest compensation you have been in 15 years. And really that's, if you look at even April, so spreads barely budged this year. Even in April, you saw a little wobble, but as compared to, I would say, stocks, bonds actually held up very well, corporate bonds. Now, the reason for this is you and I have spoken about this before. It's simple. It's the income. So you can earn 4 to 6% in return by investing in some bonds that are being issued by these, strong, big, large companies, companies like TELUS, General Motors, Air Canada. So these companies we know are not defaulting, and they're paying the income like clockwork each year. So it's no surprise that investors have been piling in. And look, whichever way you sort of slice it in terms of the corporate bonds, let's say we get a mild recession, no problem. You know what? The bonds will still rally, the prices will rally because more rate cuts will get priced in than what markets have currently priced in at the moment. If growth holds up, which is our base case, great, you're clipping this attractive income in your portfolio. So it's a win-win situation, which is quite unique to what bonds are offering at the moment. And when you look at fundamentals, 30 to 35% of companies have reported with an investment grade and high yield. And I would say we are seeing record number of companies beat earnings. There is some bifurcation, I would say, between what we are seeing between high income and low income consumers. So that's been evident and that's been ongoing. But I would say broadly, it's painting a very stable picture. And that's exactly why investment grade spreads or corporate spreads reflect this, the combination of that strong fundamental as well as that solid demand.
So we've seen the strong fundamentals, the solid demand. When we take a look at the corporate space, is some of that demand starting to come off now? Has it been weaker lately?
Not really. So I did bring a chart here with me, and let's kind of put it up here. So yes, the yields have been falling. If you look towards the end of this chart, it's been coming down. But look at how attractive it is historically still. I would say over the last 15 years, 75% of the time, the yields were lower than where they are today. So it's still attractive. And I'll give you an example. So just yesterday, Meta tapped the bond market for its massive AI-related CapEx. It was a $30 billion deal. The demand, it was $125 billion. That's the kind of money, and it gives you that perspective that that's the kind of money which is sitting on the sidelines, waiting to be deployed in markets, or in this case, bonds. And when you think about the setup right now, so that demand is still healthy, and we can get some earnings, hiccup here and there from that bifurcation that we spoke about. But broadly speaking, if you think about us as bondholders, we are. I would say we are more easily pleased than our equity friends. We don't need explosive growth to get excited. Just steady balance sheet, decent, good cash flows, and reliable coupons, and we are happy.
I think one of the reasons why people are starting to see these headlines pop up about, like, worrying about tight credit spreads or the health of the credit market. You mentioned credit wobbles. I think Jamie Dimon recently used a little more colorful language around some of these issues. Spotting a cockroach. You see one, there's probably more hiding. What did you make of those comments? Are there deeper problems in credit?
Yeah, look, this has been a fairly elongated economic cycle. So I would expect there are a few of those for sure, but it's not an infestation. So you've seen these wobbles, and I do believe that these are signs of there are some signs that there is that bifurcation we spoke about, but this is not a systemic credit stress from how we see it at the moment. And really, of course, there are pockets of weakness, as it relates to, and we've seen that ongoing, that bifurcation, as well as, let's say, with low-income consumers, with even the over-leveraged pockets of credit market, we've seen some, issuers feeling stressed, but it's not 2008. I think I want to be clear about that. Back in 2008, or during that crisis, we had a very over-leveraged, financial system, especially commercial real estate lending, residential. Banks had very thin liquidity and capital cushions. It's nothing like that right now. So if you look at banks, they've reported already, and I would say more than 80% are saying that the problem loans are stable to actually improving or falling. Early stage delinquencies, which very easy or simple terms, what it means is, how many borrowers are missing payments or are missing payments by between 30 and 60 days. So that's usually an early sign of any warning sign for any sort of financial stress, and that number has been falling as well, which means that delinquencies have been stable to improving. Banks are very well capitalized today. They're sitting on far superior liquidity at the moment. The Fed and Treasury also have experience managing those macroprudential risks that we saw back in 2023. So when you put all of these things together, we see this as a pretty clean quarter. Even when you look at the usual suspects, which are regional banks, the autos, we did see the credit quality was stable to actually improving. When you look at default rates on the corporate side, you can expect the default rates to fall in the quarters ahead, and that's simple. It's because the economy is holding up quite well, and the underlying the rates or interest rates are falling, which means that the stressed borrowers are feeling some relief here. So when you put all of this together, we don't see signs of a systemic credit stress. And if anything, the forward outlook to us looks quite optimistic from that powerful combination of the fiscal spending, the monetary policy easing, deregulation, which is on its way.
So not systemic. We see these events, so like First Brand, Tricolor, Zions. It's good to learn from these events, right? Like, what do we take away from these wobbles?
100%. And I think my view is that there were three things that this wobble, if you will, highlighted for me. The first thing is that there is that bifurcation ongoing between the strong and the weak. It could be whether we're talking about the household balance sheets or corporate balance sheets. And you're seeing that come through. What it means is you have to be more selective, and you have to be monitoring this risk because there is that dispersion that's ongoing. So we are monitoring those risks, and we are being selective. The second thing is we've seen this huge run-up in risk sentiment since April. So valuations are stretched everywhere across all risk assets. And in that situation, the markets are more exposed to any kind of shock now. So you have to be careful about looking at what price you're paying for the asset. That's key as well. The third thing I would say is more of a takeaway for me, which is exercise discipline. It's extremely important. When you put the bifurcation, the dispersion under the surface, as well as valuations in context. So doing your homework, understanding the risks thoroughly, and knowing what assets you're buying, what price are you paying, if you're lending to a corporate, what are those lending documents saying? That's all very, very important in today's backdrop and where valuations are. That's where our analysts are focused at the moment. So they're talking to management teams, stress testing those financials, and just making sure nothing slips through the cracks here.
All right, there's a lot going on. The team is doing the homework when it comes to corporate bonds. Then, how are you thinking about positioning in this environment?
Yeah, so when I think about the positioning at the moment, I would say that broadly speaking, valuations are stretched everywhere. We just spoke about that, which means that everybody has to dig a lot more deeper to find those jewels. But you know what? Even when you're digging deeper, you're not finding jewels. You're finding some shiny stones. So you have to be really, you'll be hard pressed to find anyone who's overly bullish here. However, it would be a mistake to underinvest in corporate credit. And the reason being, we just spoke about the growth outlook, which looks broadly optimistic or holding up. Yields are still elevated, and the supply and demand picture on bond side is still skewing to seeing more demand than supply, which means that corporate credit spreads can hold up okay and well. So instead of underinvesting in corporate credit because you're seeing some of the dispersion, instead what you should do is you should be selective. I think that's key. So within investment grade, we're okay skewing down in quality which I mean is BBB rated companies. We're okay going there because we're seeing fundamentals still solid, and these companies are still being upgraded. We're seeing more upgrades in credit quality than downgrades, and we get that extra yield as well. On the high yield side, I would say we're skewing to higher quality within high yield. And that's the pocket where we see low credit risk and we see fundamentals holding up well. So it is about being selective in this market. Overall, I would say constructive in credit, just not aggressive. And when you think as an investor, what I would say is stick to quality, don't go too long on tenor, and clip those attractive coupons and let them do the heavy lifting for you at this moment.